Have you ever listened to an earnings call where a company talks up all this great news, all this progress, only to see its stock completely tank the next day? It's one of those classic Wall Street head scratchers. Well, today we're going to break down a perfect example of this, the very curious case of ClearSign Technologies. So get this. The CEO comes out and says the company is making significant progress on its biggest projects. You'd expect a pop in the stock, right? Or at least for it to hold steady. Instead, it drops over 8%. What is going on here? That's the paradox we are going to unpack. And here it is, laid out plain as day. On one side, you have the CEO, Jim Dealer, painting a picture of forward momentum. And on the other, you have the market's reaction, a swift negative judgment in the form of an 8.2% drop. These are two completely different stories being told about the same company on the same day. So here's how we're going to tackle this. First, we'll dive into the optimistic story the company was telling. Then we'll look at the market's stone-cold reaction and why it happened. After that, we'll connect the dots and bridge that gap. And finally, we'll look at what you really need to watch for going forward. All right, first up, let's put ourselves in ClearSign's shoes. Their whole earnings call, their whole narrative, it wasn't really about the last 3 months. It was all about building for the future, and they were really focused on their technical achievements and this growing pipeline of work. And look, they laid out a pretty packed schedule of what's coming up. They're talking about a huge 20-burner project in California starting up like any day now, then a massive 26-burner project shipping out later this year. They're trying to show investors, hey, the big stuff is right around the corner. And it wasn't just about the projects we already knew about. No, they were highlighting a whole slate of new technology. A brand new, cheaper burner to open up new markets. A high-tech sensor getting tested by one of the biggest oil companies in the world. And get this, the value of their proposals for flare systems is up 10 times year over year. This is the innovation story they really wanted everyone to hear. And the CEO, Jim Dealer, he really put a fine point on it. He's basically saying, listen, what we're doing is hard. It takes time. But all this work, this is the foundation for everything that comes next. He's selling the long-term vision. Okay, so that was the company's story. It's all about the future, the foundation, the pipeline. But the market? Yeah, the market heard something completely different. It wasn't interested in the vision for tomorrow. It was looking at the cold, hard numbers from today. And it really all boiled down to this one number, $133,000. That was their total revenue for the entire quarter. And when you see a number that small, it immediately makes you stop and ask, wait, what? But that number doesn't even tell the whole story. You have to see it in context. Because Wall Street was expecting more than 4 times that amount. They were looking for about $640,000. So that gap you see on the chart, that chasm, in the eyes of the market, that's a massive failure. Let's just put it bluntly. It was a 79% miss on revenue. For investors who are laser-focused on quarterly performance and hitting targets, a number like that just drowns out everything else. All the talk about future growth just becomes noise. And it wasn't just that one number. When investors started digging, they saw other things that made them nervous. There were no new purchase orders announced. Nothing had come through yet from their big partnership with Zeeco. They heard the words timing slippage for a major project, and they even saw that R&D spending was cut. So to the market, these weren't signs of building a foundation. They looked a lot like red flags. So how can both of these stories be true at the same time? How can the company see progress while the market sees failure? Well, it's because they're looking at the same coin, but from opposite sides. They're playing two completely different games. And the name of that game is something called Project Lumpiness. See, ClearSign doesn't sell subscriptions or widgets. They sell massive, complex engineering projects. That means revenue doesn't come in a nice, smooth line. It comes in big, infrequent, and sometimes unpredictable chunks. This makes their quarterly numbers incredibly choppy, and honestly, a pretty terrible way to judge their actual progress. And this right here, this is the heart of the whole paradox. Management is focused on the long game. Are we hitting our technical milestones? Is the pipeline growing? Are our partnerships strong? But the market, especially on earnings day, is playing a short game. It's asking, what were your results this quarter? How many new orders did you sign? They're just looking at the company through two totally different lenses.
So why is the company so confident then? It's because of their secret weapon, something called CFD. Think of it like an MRI for a jet engine. It lets them see exactly what's happening inside their systems and perfect their technology before they even build it. This is their core advantage. They believe this technical edge is the real value of the company, not just the revenue from one 90-day period.
So the big question is, which narrative is going to win out in the long run? Is it the company's story of future potential or the market story of current disappointment? To figure that out, we need to know what to watch for. And the company has actually given us a very clear roadmap of what could change everything. Here are the 4 big milestones that could totally flip the script. First, that California project has to start up and run perfectly. That becomes a massive proof point for the entire industry. Second, when they ship the Gulf Coast project, that's not just a milestone, that's a huge chunk of revenue that will finally hit the books. Third, they need to land that first order with their partner Zeeco. That proves the whole partnership model works. And finally, that hydrogen demo is their ticket into a massive high-growth market. These are the catalysts that can turn vision into value. And here's the kicker. Here's why they might just have enough time to hit those milestones. Buried in the numbers was some really good news. Their cash position is solid, over $12 million. But more importantly, look at how much cash they're using. They cut their cash burn by 2/3 compared to last year. That is a huge improvement in financial discipline, and it gives them the runway they need to let these big projects play out. Which leaves us with this final fundamental question. For a company like ClearSign, the earnings call paradox wasn't really about a good quarter or a bad quarter. It was a clash of timelines. A company selling its future potential, and a market that was only willing to price its present-day reality. The real story here is about what happens next, and which of those two timelines ultimately wins.